Do you feel stuck with unrealized stock gains with no way out of a huge tax bill? There are smart strategies that can help you transition out of this position while even creating tax write-offs. Coming up in this video, you'll see how to minimize or potentially even eliminate capital gains taxes, how tax loss harvesting can offset your gains and lower your tax bill, why stocks, especially in a volatile market, have unique tax advantages that some investors do tend to overlook. And if you're already sitting on an unrealized gain, you'll see what you can do today to invest tax efficiently and into the future. Stick around because these strategies could add thousands or maybe even tens of thousands of dollars onto your net worth. Imagine you've spent weeks working on a huge 1,000-piece puzzle. You've carefully placed every piece and you're finally about to finish. But right at the end, you realize one crucial piece is missing. No matter how great the rest of the puzzle looks, that one missing piece makes it feel incomplete, frustrating, and kind of like it was all just a big waste of time. Investing without a tax plan is just like that. You pick the best stocks, you make smart trades, and you grow your portfolio. But if you don't have a strategy to navigate capital gains taxes, you're leaving a massive hole in your financial picture. And just like that puzzle, a great investment portfolio without tax planning is incomplete. If you're not managing taxes properly, you're not creating the wealth you could be. The good news about all this, today you'll see exactly how to find that missing piece and complete the puzzle the right way. This will keep more of your money where it belongs, right in your bank account. Let's start with the problem. Capital gains taxes silently eat away at your investment returns if you're not careful. As a quick refresher, there are two types of capital gains taxes. The first is short-term capital gains. If you sell a stock you've held for less than a year, you'll pay taxes at your ordinary income tax rate. For high earners, which some of my clients are, it could be as high as 37%. The second is long-term capital gains. If you hold a stock for more than a year, you qualify for a lower tax rate, 20%. Some investors don't even realize how much taxes they're paying. If you pay 25 to 37% on every profitable trade, that's money you're not reinvesting. That's money you're not compounding, and it means a lot less growth. So, how do you make sure you keep more? Let's talk about tax loss harvesting. One of the best ways to offset capital gains taxes is through tax loss harvesting. It's a strategy where you sell stocks that have experienced a sell-off, cancel out the taxable gains from winning stocks. I know. Selling for a loss sounds terrible. Some people, not most, but some people hear it and they want to run away immediately. But once you build this strategy into your portfolio, it can be a real blessing. So let's just say you sell a stock and you make a $10,000 gain. Normally, you'd owe capital gains tax on that profit. But what if you sell another stock at a $10,000 loss? That means the two cancel each other out, meaning there's zero taxable gain. This is not about losing money on purpose. You're strategically realizing losses to manage your tax bill. Because once you sell to tax harvest, you don't just sit in cash. You get right back into the market. And historically, the stock market has increased in value over time. Think back for a second onto the year 2020. I know, it's painful. But for this strategy, it was amazing. The market sold off in the beginning of the year, and you could easily harvest losses in the downturn. By the time we reached December at the end of the year, the market was higher than it was 12 months earlier in January, meaning you could have a larger portfolio year over year and still have tax write-offs to show your accountant in April. Pretty cool, huh? A bonus tip is to watch out for the wash sale rule. There is one important rule to keep in mind if you implement tax loss harvesting on your own, the wash sale rule. If you sell a stock at a loss and then buy it back within 30 days, the IRS disallows that loss for tax purposes. So Instead of rebuying the same stock, you need to replace it with a similar but not identical stock. Then when the market rallies, you can catch the upside. Let's talk about why market volatility can actually help you maximize your net worth. A lot of investors can fear market drops, but with tax harvesting, volatility actually creates the opportunities. When the market does dip, it allows you to harvest losses more frequently, rebalance your portfolio with lower tax costs, and maximize the advantage of direct indexing. A direct indexing is a strategy that automatically will swap individual stocks or ETFs that trade within the same index to maximize tax benefits while getting the return of the index writ large. And something that investors can overlook, stocks are actually better for tax loss harvesting than bonds. First, bonds often generate interest income, which is taxed at ordinary income rates. Typically, they're higher than capital gains taxes. Secondly, stocks are liquid, easy to trade, and volatile, making them the perfect asset class for tax-efficient investing. Direct indexing will generate tax write-offs within an automated system. It's like getting all the returns of an index fund, but with much better tax benefits. Now, here's where things get interesting. Most investors assume that if they harvest losses, the savings only apply to the portfolio where those taxes were harvested. But you own those tax write-offs. They don't have to stay in the portfolio that generated them. This means you can apply those write-offs to any gains you have anywhere you want in any portfolio or to any appreciated asset. An example of this is that a client of mine had a long-held stock position from her RSUs, equity compensation from her employer, that vested and compounded over time. Eventually, she had an unrealized net gain of about $50,000. And normally selling would have triggered a huge tax bill for her. But if you harvested $50,000 in losses, you can use those to offset the gain. The result? Zero capital gains tax. This is how tax-aware investors exit highly appreciated stock positions without taking a major tax hit. This strategy isn't just about saving money today. It's about investing tax efficiently over the long run. It helps you keep more of what you earn and let compounding do its job. Now that you know how to avoid capital gains tax with tax loss harvesting and portfolio adjustments, there's still one big question left. Is direct indexing actually worth it for your portfolio? For some investors, the tax benefits make it a no-brainer, but for others, the complexity might not be worth it. So in my next video, I'll break down exactly who should and who shouldn't use direct indexing, how to calculate whether it makes sense for you, and what alternative strategies might be a better fit. So click here to watch it now.